Inflation and diversification are both bromides. There are these simplistic terms that people toss around, but no one really thinks very deeply about them in my experience. Now, if you go to diversification, it's another bromide, another silliness. You should be diversified. Lots of people say that. A lot of times the people that say that to you want you to give them your money.
Welcome to Dream Richer. What do you think is considered to be the best investment advice? According to investors such as Warren Buffett, Cathie Wood, and Kevin O'Leary, the answer is simple: portfolio diversification. In fact, Warren Buffett has a famous saying, to never put all your eggs in the same basket. Every newbie who enters the investment market is taught the concept of diversification. But is it entirely true? What if it holds more disadvantages than advantages? Today, the billionaire investor and CEO of Microstrategy, Mr. Michael Saylor, breaks down this theory of portfolio diversification. The main reason for advocating this advice is that if anything bad were to happen to your basket of different investments, you wouldn't have to lose all your eggs. That's the underlying principle of a diversified portfolio. Even though the ideal strategy for diversified investments is to adopt an asset allocation based on your risk profile. However, it could potentially hurt you in the long term, according to Mr. Saylor. Let us know what you think about this strategy in comments below. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
The inflation rate in 2020 was about 25% for assets. The inflation rate for bonds was at one point higher, right? You could have bought a bond for $1 million that yielded $50,000 in interest a decade ago. If you wanted Social Security, if you wanted $50,000 in income risk-free the rest of your life, the cost was $1 million. When the 10-year yield went to 50 basis points, you would have to pay $10 million for the same bond. The bond went up by a factor of 10. What's the inflation rate? Right? The inflation rate in that particular case was 100%. It was like hyperinflation. So we have had hyperinflation since 1971, but the inflation has manifested itself in the assets. Here's the pernicious thing about it. I've literally brainwashed you into thinking that asset inflation isn't a bad thing, it's a good thing, and it isn't inflation at all. It's actually investment gain, right? So when I convince you that a bad thing is a good thing, right, we've come to a bizarre point. So we're living in inflation since we went off the gold standard. It's just manifested in the assets. We have hyperinflation right now. It's just manifesting itself in the assets more so than in the goods and services.
To diversify your portfolio, you can choose from various asset classes. Equities, which usually perform better than most assets, can be further broken down into large, mid, and small cap stocks. Within equities, you can diversify your portfolio further. Other asset classes include fixed income instruments, such as fixed deposits, government bonds, and debentures for a steady income. They are less risky, but their returns are generally lower than returns in equities. Gold, ETFs, and real estate are other asset classes you can explore. The biggest disadvantage of portfolio diversification, however, comes down to four main factors. Number 1, it increases your chances of making mistakes. 2, there are different rules for each asset. 3, increase in tax implications and your cost of investment. And finally, disadvantage number 4, it puts a cap on your total profit growth.
Now, if you go to diversification, it's another bromide, another silliness. You should be diversified. Lots of people say that. A lot of times the people that say that to you want you to give them your money. It's like I'm a hedge fund manager, and so I'm going to stand up and tell you need a broadly diversified portfolio of like international equities and domestic equities and like some of these commodities, and it changes all the time, and it's very complicated. It's too complicated for you to figure out, so you just give me your money. I'm going to charge you a 2% fee, keep 20% of the upside, and I'm going to invest it in this hyper-complicated array, diversification of stuff. I'll give you a simple idea. Go buy Bitcoin. Don't give me anything. I don't want your money. I don't want the 2%. I don't want 20% of the upside. And Bitcoin is a diversified index of the entire world economy. On the other hand, what's the problem with diversification? First of all, the problem with diversification is selling the winner to buy the losers. And the second problem with diversification is you're not really diversified at all because everything you own is probably correlated to one currency, which is collapsing. So your diversification strategy with any given currency, whether it's the peso, the dollar, the euro, the ruble, the lira, the whatever, they're all correlated. So then you're like, okay, well, this is great. I'm just going to buy the dollar. All the currencies are correlated to the dollar, and the dollar's collapsing. How fast is the dollar collapsing? Well, you can watch it against real estate in Miami Beach. All you got to do is look at the dollar versus any scarce desirable piece of property. So what's the dollar valued in versus a Picasso, a Leonardo da Vinci, a city block in New York City, a desirable piece of beachfront property, and how about Palm Beach, right? What's happened to Palm Beach property in the past 10 years? So ultimately, the problem with diversification is nearly everything, every stock is correlated and every conventional asset is generally correlated. The only true diversification is if you find non-sovereign stores of value that derive their value based upon something other than the cash flows that you could derive from them.
It's clear from Michael Saylor's explanation that portfolio diversification may help you mitigate risks in the short term. However, it puts a cap on your profits. As Mr. Saylor argues, there will only ever be one winner. So if you want to make the most money, then bet on the winner, which in this case is Bitcoin. Nonetheless, the sound principles of diversification still ring true. By holding a diversified portfolio, you can counter the risk of losing all your money from one bad investment. Also, it is possible that the losses made from one investment will be made up for by other investments. However, it is equally essential to be cautious, not to over-diversify. Carry out a thorough check. Ensure the asset allocation is aligned with your financial goals. Be aware of the cost of investing. And be mindful of the asset allocation's tax implication while building your diversified portfolio. To learn more about the latest crypto news, watch these videos here.